Good evening and welcome to Live with Shawna at Shaw-Roco Solutions. For those of you who don't know me, I'm a real estate investor and I focus on helping Albertans become homeowners in the Calgary area as well as Edmonton, so on and so forth, so all of Alberta. And with that as well, I also work with joint venture partners in our real estate investing deals and other investors as well. So with that, tonight I wanted to talk about, it's always interesting because you're trying to think of what different topics can I talk to people about and where can I add some value. And so lately I've been talking to people I work with and so on and so forth about, my business. And as you talk about it, people ask you certain questions. So I'm like, okay, well, I'm going to make note here and then maybe that's something I'll talk about. So tonight I wanted to talk to you about some of the questions I've been getting. And the questions I've been getting are all about recently, friends, family, so on and so forth, about joint venture partners. So how exactly it works when you're doing a real estate investment with a joint venture partner. So for some of the common questions I've been asking, and I'm sure other investors get this all the time as well, is investing in real estate risky? So it's always something to just talk about right off the start, kind of get it out there and say, no matter what you do as far as investments, there's going to be some level of risk involved. When it comes to real estate investing, the nice part is the risks involved aren't, they're minor compared to some other investments. So some of the risks involved would be like, say for instance, vacancies. So vacancies is one of the things, as well as maintenance, expenses, and then you start to look at, okay, a downturn economy. Selling a property in a downturn economy, what exactly are the risks involved with that? So am I going to lose my shirt? Am I not going to lose my shirt? So having said that, it's very important to me and my business, and me and my partner, Bernie, at Shaw-Roco Solutions, that we do our due diligence and we really understand what limit the risks as far as like for vacancies. So when we're looking at a rent-to-hold property or a rent-to-own property where you're dealing with tenants, you always want to make sure you yourself, like for us, we understand how to screen the tenants properly, or we bring in someone from our team member to work with us to make sure we do our due diligence. We screen them properly, they're good tenants. There's going to be times where the market, up or down and people have to leave and so on and so forth. And if that's the case, have it worked out where, okay, we have so much put aside for a little bit of vacancy, they move out, we can get some new tenants in right away. And right now with the way mortgages are going and people qualifying, and the stress test coming out January 1, there's definitely a lot more people looking at renting these days. So it's just very important, like for us, that you screen them properly. So it minimizes the risk there as far as vacancies. When it comes to your expenses and maintenance, again, we rely a lot on our team. So we're working with property managers, building inspectors, and as well as realtors when you're looking at that, because you want to take a look at your property and you want to understand exactly where the maintenance is going to go with this building. Is it a certain, like say a duplex for instance, that's 20 years old? When's the last time the furnace was changed? When's the last time the hot water tank was changed? Do the shingles need to be changed? Whatever the situation is, we work with our professionals to understand what is going on with that property, what is going to be required from us to put out in, like 6 months or a year or 2 years kind of thing. So then we can work with that and work in our numbers and prepare for that, as well as completely just understanding, running the numbers and understanding what the expenses are involved. Where some people down the road, when you're starting out real estate investing and you don't quite understand how to run the numbers, it's really important to look at all these factors and understand where you're coming from, so that if a situation arises, you're covered. Because you don't want to, at the end of the day, you want to cash flow. You don't want to lose your butt on this property. So for us, we're careful that we do our due diligence that way. So with that in mind, it's generally speaking, the real estate market is less volatile than, like, say, a stock market. So with the real estate, you actually have a physical asset backing your money. So that's why we've chosen to get involved with real estate investing, as well as we feel it's very important to educate yourself and to understand how to run the numbers and know what strategy you need coming in and what strategy you need going out and how you want to cash flow. And I'm actually proud to say that I have spent the last 10 months educating myself inside and out and really kind of understanding different strategies to work with, and where to go, and we can look at a property and assess it, and we have this wonderful team of people that we work with. So that's one of the things at Shaw-Roco Solutions that we look at when we're teaming up with joint venture partners, because we want you to feel comfortable with us as well as we want to feel comfortable with you. And then another question I get asked is, what is a joint venture partner? So kind of like the technical terms, and I'll just read this. It's an agreement joining together two or more parties for the purpose of executing a particular real estate undertaking. So each party is committed to perform certain duties, and then you must live it up to those commitments. So that's kind of like the technical term of it. For us, when you get into the next question, it's kind of like, what types of joint venture partners are there? So for us, that's a really good question, because when we're looking at properties, it's always going to depend on what property we get under contract and what strategy we're working with at that time. So for instance, if we're looking at, an opportunity comes up for a fix and flip. And fix and flips, there's all these fix and flippers out there that are doing wonderful jobs. One thing I'm really finding out with the fix and flip is sometimes, especially like in the Calgary market, if a house comes on the market and it's like, oh my gosh, I get a phone call, there's this good fix and flip opportunity. It's like, great, you get a phone call, and literally by 4 o'clock that day, or a few hours later, whatever, there's already been some multiple offers in it. So when you're looking at joint venture partnering with a fix and flip, you pretty much have to have your money ready to go at a certain, say for instance, an example is a property came in, on the market, it's like $470,000, but it came in and we had an opportunity to buy it at $320,000. So when it comes in like that, you pretty much have to have the cash ready to go, because other investors are coming in, other realtors are coming in, like people are going to be coming in and putting your offer. So you need to be able to come in, put your offer, get that under contract, and then work from there. And so for us, one of the joint ventures is contractors. So there may be a certain, like I was saying with the fix and flips, where all of a sudden we work with a contractor, where we bring him in and then we go over the whole deal, and then he lets us know, here's what needs to be done on the property, and we sit down, we're like, hey, you cover this, we cover this, and then we work out how it's going to work out in the end. So that's one type of joint venture. So there's teaming up with contractors. Another one is credit partners. Because there comes a time, whether personally or through your business, you can only qualify for so many mortgages, where then all of a sudden you're tapped out. And that happens all the time with investors. So when you get to that point where you're tapped out, then you need to team up with people who have a good credit. And so they want to partner with you, and then basically they bring their credit to the table. So when you look at a property, we bring the money, they bring the credit. So in that situation, you have to have a certain credit score and so on and so forth. So that's one form where your part of it is just actually being able to have the credit to qualify for the mortgage. So another partner is a financing partner. And with a financing partner, it just depends. Like in a situation, I talk about my rent-to-owns a lot. So with a rent-to-own, for instance, you could be looking at a rent-to-own property, and so you can joint venture with somebody on the financing side of it, where the property is worth, say, $500,000, but you need your 20% down to get in. So then they lend you the 20% down. They give us the 20% down, we get them in, and then we work out our deal from there. And their return on investment, whether it's quarterly, we're going to pay them back. However we negotiate the agreement from there. So there's always the different financing partners, and there's always going to be different kinds of financing partners. Again, it's going to depend on the property. There may be an instance where we're looking at a multi-unit property, so like a 5-plex or a 6-plex. Well, typically I think it's 5 and 6-plex, where you're actually The building itself can qualify for the mortgage because it may be like considered a residential property. However, it's a commercial mortgage. So the property itself will qualify for the mortgage, but then you need to obviously have the money down payment to put in. And now you're looking at 5plex, 6plex, you're looking at more money. So then you team up again with the financing person for your down payment, and then you work the deal based on that and what you agree with, how they want to be paid back, the return on investment, and so on and so forth. So that's kind of a few examples of a financing partner. So again, at the end of the day, it really does, when it comes to real estate investing, there's so many different factors that you're looking at here, as far as what strategy going in, what strategy coming out. It may be a combination of partners. Say, for instance, you do a fix and flip, and then you team up with somebody, and you have your contractor on one side of it, then you have a money person on the other side of it. So it just kind of depends how you want to work your strategy, where we're at with our business, where we sit down, and the big part of it is just understanding what your needs are, which kind of brings me into our next question that I get asked, and that is, what is the joint process? Like, how does it work if you want a joint venture partner with us? So when people are looking at joint venture partner and we sit down with you, there's different factors again involved. The big thing is we need to sit down and we need to understand, what are your financial goals? Where do you want to go? Where do you want to be? How do you want to get there? Because in some cases, there may be, say you're in your 30s and you have young kids and you're like, okay, my goal is to put my children through university. However, we have, some money. Say, for instance, and I'll get more into different methods with your money, but say, for instance, you got an inheritance or something and your money is just not doing what you want. So you're like, okay, I'm going to start investing in real estate because I want to, here's my goals. I want, in 15 years, I want to be able to put my kids through university, college, whatever. So it just depends what your goals are. So whether it's putting your kids through college, university, whether it's just saving up for retirement, that you want to, build some wealth for retirement, whether you want to travel the world, or say, for instance, it's just you want to start getting your own portfolio. So you want to have a few portfolio properties under your own portfolio. So there's different ways we work with you. So it's very important for us that we just understand what your goals are, and then we can sit down and we can say, okay, so now we understand, we kind of know what your age is, where you want to go. So then we sit down and say, okay, what exactly is your investment method? Meaning, what do you have? So it's, in some cases it can be, well, we have cash. Like I said earlier, we have an inheritance. We have this money. We want to do something with it. Okay, great. Then we take a look at that. For instance, maybe you don't have that, but you have RSPs and you're not happy with the return you've been getting on your RSPs. So then what we do is we team up with, there's a company out there called Olympia Trust. And so we can move your RSPs, you can move your RSPs from where they're at into a self-directed RSP, and then from there, under the Canadian portfolio or products that you can choose for your RSPs, Canada mortgages are one of them. So from there, you can then lend your money out, and you kind of become like a private lender on your money from your RSPs. And depending on the deal, depending on your payback, your cash flow, then you get so much a month or a quarter, and you start putting it back in there. And then you get, of course, your return on investment on your initial, whatever your amount was given to us to invest. So there's different ways with your RSPs. And if your RSPs are something that, because I know a lot of people right now, including ourselves, you're just not happy with the return or what's happening. So there's a really great book out there, and it's called RSP Secret. And the author is Greg Habstrat, Habstrit, Habstrit, I said that wrong. Great book. So if it's something that you're thinking of doing, definitely get this book, get on your Kobo, buy a hardcover, whatever you want. So great book to read. Another form of your investment, your money, is loans, meaning home equity, your HELOC, home equity line of credit. So a lot of people are really nervous, like going, oh, I don't want to touch my equity, I don't want to touch my equity, and that's fine. But in some cases, you may sit there and say, okay, my house is paid off. I have this much equity. I'm not going to retire, or I'm not going to do anything for this many years. Why not take some of that money out and have it make money for me? So I want my money to make money for me. And then with that, then we sit down and we say, okay, and then we work on a strategy from there on what we can do with that money. And again, when you're lending it out on a home line of credit, there's your where you're charged your insurance rate, your interest rate. So then we sit down and we work that into the numbers as well, that here's your interest rate From there, we make sure, that that's covered, and then, our return on investment from there, and so on and so forth. So whatever you want to do, if it's your TFSAs, your LIRAs, your GICs, it's important that we sit down with you and we figure out where you want to go with your money, and then what like I said, what method you want to use, and then from there, it's really important to understand your risk tolerance. So, for instance, if you're just like, okay, well, I want to do a 3 to 6 month term, and I'll take some money out of my line of credit, or however you want to work it. Then from there, we would look at fix and flips properties, because a fix and flip is usually, 3 to 6 month term kind of thing. So that's where you would be kind of in your short term investment. If you're looking at something that's, 2 to 3 years time, 4 years, then we would look at a rent to own property. That would be considered your medium term. And then from there, we would look at, all of a sudden we look at your whole portfolio, and we're sitting there and you're like, okay, I have, 10, 15 years, whatever, but I just want to maybe 5 years. So for 5-year term, which is considered a long term, 5 to 10 years, then we look at, buy, rent, and hold properties. So from there, we look at, you can look at duplexes, you can look at fourplexes, multifamily, small apartment buildings, whatever it may be. So we sit down with you, we ask you a few simple questions, we determine how comfortable you are, where you're at, so on and so forth. And then after we go through this process with you, we sit down and then we say, okay, here's how we suggest that would be the best way to invest your money. And then from there, what we do is we build a database. So we have a database where all of a sudden, a property comes up and you're like, you definitely want to be a 3 to 6 month term person. Well, there isn't always fix and flips that we might have available to us, but like one came up a couple of weeks ago. So all of a sudden it's like we get this, fix and flip. We build up our database of our joint venture partners. So then we're able to go to that database and go, oh, remember when we were talking to Joe and Mary Smith and they want this? So then we take a look at it and we're like, hey, we have this opportunity. What do you think? Run the numbers. We actually sit down and we go through the numbers with you. We make it so you are completely comfortable in going through the investment. Like, we don't ever want somebody, the last thing I would want was somebody to be terrified, to joint venture with us. It's got to be a win-win situation, and you got to be comfortable with us. We have to be comfortable with you, because at the end of the day, when we're getting properties under contract, we don't want to sit there and then all of a sudden at the 11th hour, for whatever reason, our joint venture's got cold feet, and then we're sitting here and we're like, okay, now what do we do, kind of thing. But we're always going to have our exit clauses. But you want to make sure that before you get to that point, that the joint venture partners you're working with are very comfortable. And so that's what I like to do, is make sure everybody's in a comfortable situation. And like I said, we just build up our database, and we have our short-term investors, our medium, our long-term, and then as the properties come up and so on and so forth, we do our due diligence with our team and we decide, okay, where do we want to go with this, and then we go from there with our joint ventures. So that's kind of a little bit, a long version, but that's kind of a little bit more about the process of how we like to do things. So yeah, that's it for tonight, everybody. If you have any questions, thank you very much for joining me. And if you're watching the replay and you have questions, by all means, just put them in the comment box or get a hold of me through Shaw-Roco Solutions, www.shawrocosolutions.com. And I will be back next week, not Wednesday night, because I actually have an event I'm going to. So I will be back Thursday night, the 16th at 7 p.m. For my Facebook Live with Shawna. And if anybody has something where you have more questions or you want me to talk about in one of the live sessions, by all means. I'm even thinking of in the new year bringing on some of my team that I deal with, some of my mortgage brokers, my realtors, and maybe doing a little interview so then you guys can get to meet part of my team, and then we can go from there. So thank you very much for everybody for being here tonight. And like I said, those of you watching the replay, thank you as well. And take care everybody, and have a wonderful evening. Thank you.